Hello, wonderful people! Welcome back! We are now on video 2 for chapter 14. We're still discussing monetary policy. We have a question that says who can borrow money from banks? Just about anybody. It can be an individual proprietor. It can be a corporation. It can be you guys, graduates. It can be any other bank. It can be a foreigner. It can be a US citizen or a non-US citizen, like pretty much anybody in the world, a young person, an older person, doesn't matter. It can be in entire cities, entire municipalities. It can be a state. Anybody looking to borrow, whether they are domestic or foreign, whether they're an individual or a business or a government entity, can actually borrow money from banks. And so yes, banks can borrow from banks. They do borrow from each other. Now, the money creation process. How does it happen? The Federal Reserve is responsible for the amount of money in an economy and the value of money in that economy. We learned that way back then, right? Well, how do they determine what to do? If they want to add money and if they want to subtract money, how do they do it? So we have an example here. First of all, I want to walk you through this a little bit. Here's what you're looking at. You're looking at an individual who spends money. They spend this money, right, with a company. The company is going to earn this income and dispense some of it in the form of salaries. Some of this is going to go into savings, and some of it is going to be deposited in the bank in the form of in checking accounts to be spent. Then the bank can lend this money to someone else, and that person can spend, feed businesses, feed people's income, who can then save and invest, and then put more money in checking accounts that can be lent out some more. So what we want to know is if the Fed wants to increase the money supply by $10,000, which is of course a very, very small amount, what do they do? Do they print $10,000? No, they only print 1,000. Why? The banks will actually print the 9,000 differential using excess reserves. And because excess reserves are 90%, then the banks actually increase the money supply by that 90% required. So the Fed prints $1,000 and deposits it into a bank. The bank then gives the first person $900 over here and keeps $100. $100 in required reserves, $900 in excess reserves. Nobody borrows to save. People don't borrow money so it doesn't make sense. So when people borrow money, they're going to spend it. And because they're going to spend it, they're going to put it in a savings account. A checking account. That's most likely what's going to happen. So this person takes their $900 and puts it into their bank. Doesn't matter which bank, any bank. That bank will then separate the $900 into 10% required reserves of $90 and $810 of excess reserves given to another person. This person then deposits the money into their checking account, and then the bank does the same. They split it one more time. $81, that's going to be put aside in required reserves, and the $729 that's going to be lent out, and so forth and so on. If you sit down to do the math, it will take you a very, very long time, especially when you get down to lower numbers. It would be a very tedious, annoying job. But if you were to do that, you will find that the total that was created by the banks is $9,000. When you add that 9,000 to the 1,000 here is how you have 10,000. So if this was 10 billion, then the bank would produce 1 billion and deposit. If this was 100 billion, then 10 billion are going to be produced or printed and deposited, and the rest will be done by banks. This is how banks create money. They cannot print money, but they can create it. Okay. The structure of the Federal Reserves and its purpose. By the way, the cash in this country, the currency in the US, is actually printed in Dalton, Massachusetts, and you can very much go tour that. At least we used to be able to tour that plant. Hopefully you can still tour that plant today. And they do make beautiful cards and a bunch of other things, but definitely they also print with a special ink. They print the money. I mean, they don't put the ink on it, they just produce the actual linen paper. So here's the structure of the Federal Reserves and its purpose. The Federal Reserve is the central bank of the United States. Other countries, like the European Central Bank, they actually use that. We use the Federal Reserve. The Federal Reserve was created in 1913 for many reasons. One of them is to stop any conflict of interest with the Treasury. And so here you have the Federal Reserve System, 3 key entities. The Federal Reserve Board of Governors, there are 7 of them. They are presidentially appointed and Senate confirmed. It's pretty much how it works, whether it's a federal level or whether, usually, when somebody is appointed, even if it's a state level, it would be the governor who appoints them and the Senate who would confirm them. But in this case, obviously, it's the president and the U.S. Senate. There are 12 reserve banks, therefore there are 12 presidents of those banks. They form together, 12 of them, the 7 governors plus 5 presidents from the 12 districts, they form the Federal Open Market Committee, the FOMC. Now, who are these 5 presidents? The president that sits in for the Federal Reserve Bank in New York is always guaranteed a seat. New York is the financial hub of not just the United States, but pretty much the world. Therefore, it's a perk. The other 4 rotate amongst the remaining 11 districts. What do? They set monetary policy and dictate everything that happens with the FOMC. So, what are they? Conducting the nation's monetary policy, helping maintain the stability of the financial system, supervising and regulating financial institutions, fostering payment and settlement system safety and efficiency, and promoting consumer protection and community development. So I'll break this down a little bit more towards the end, but this gives you an idea of what we are looking at. Now, the open market operations, that's that FOMC. The Open Market Committee decides on open market operations, and they are the buying and selling of securities. Now remember, securities is any bill, note, or bond. So when the Federal Reserve purchases securities, it is called an open market purchase. When they are purchasing, what they're doing is they are increasing the reserves in the banking system, and the federal funds rate declines, right? So the federal funds rate is a very specific interest, and that's going to go down. So what they're doing here is they're stimulating the economy, they're increasing the real GDP, they're seeing a need to push the economy out and, just bolster it. And because of that, we end up with cheaper loans, so people go out and spend. And remember, we don't borrow to save, we borrow to spend. And at the same time, it makes money more accessible. And naturally, when there's more of something, greater supply of money, then the interest rates are going to drop, because that is the price of borrowing. Now, if they were holding an open market sale and they're selling, so it's called an open market purchase when they're buying securities. It's called an open market sale when they are selling securities. And in this case, what they're worried about is high inflation, kind of what's happening right now. So what they do is they end up shrinking the reserves in banks. And we're going to talk a little bit about how they do that in a minute. But they shrink the reserves in banks and they increase the federal funds rates. And as you know, interest rates have been higher. I'm sure you realize that in this past several months, there's been a big reversal, for instance, in real estate, where instead of lots of people chasing too few houses, now the inventory is lingering, and there are fewer buyers, and that's because the mortgage rates have gone up so much. And the reason the Fed has allowed this to happen is because they're so worried about an inflation that continues to be around 8.6, 8.7%, and they find that to be too high. Now, we are expecting it to drop, and next year it's supposed to drop below 6, but I hope it drops way below that, way less than that. But below 6 is better than, 8 something, but it is still too high, So the Fed continues right now to be focusing on this end, on the right side of the equation, which is the open market sales. Now, as far as how they do that, you know what? I am going to stop this video right here. I will pick it up in video 3 from this point, so we keep it closer to 10 minutes intact. Okay, so we'll come back in video 3 and finish this discussion.